Good afternoon, everyone. Welcome to the November market update. We have Mr. Rick Sharga here. Hello, Rick.
Jeff, good to see
And
you.
a special guest all the way from the LA office, Mr. Mark Heenan.
Thank you, Jeff. Glad to be here.
Here on the East Coast, the leaves are down, but we still got the great weather.
It's lovely outside. Nothing to complain about.
All right. So tons to get into, Rick. We got the election behind us. Thank goodness. No more television ads, just taking everything over in our lives. And we had a result. And of course, being in the finance business, mortgage, real estate, first question we have is, with the new Trump administration coming on board, what do we expect is going to come down our way?
Well, that's a great question, Jeff. And the reality is, at least in this case, we have a little bit of a track record to fall back on and see what is likely to happen in the next 4 years. And there are some positives and some negatives from a housing market perspective that we can talk about today. I believe one of the achievements from the first Trump administration that didn't get enough credit was the success of the Opportunity Zone program, the qualified opportunity zones. And for people not familiar with that, it was a way that investors could delay or defer, or in some cases, decrease the amount of capital gains taxes they were paying by investing those funds into underserved and underdeveloped communities. And it created sort of a win-win in that those areas that desperately needed development funds were getting money, and these investors were getting a break, at least temporarily, on capital gains. And there were some requirements involved. You had to be increasing the value of the local properties by a certain amount. You had to commit to having the money stay in that area for a certain number of years, and so forth and so on. But we've seen a lot of development of both commercial and residential properties in those zones. The opportunity zones were all selected by state legislatures, so this wasn't the federal government coming in and saying this is where you'll spend the money. And I think we might see that program expanded a little bit in the next Trump administration, because it really was a very useful program, and again created a very rare win-win in terms of a public-private partnership. So that's one of the things I think we might see happen in the next 4 years.
So salt, it's something that we use on our roads here in the Northeast in the not too distant future, I might add. But more importantly, the salt deduction. For some states, it has really been a big bugaboo. And it's been a topic during the campaign season. Where do you see the Trump administration landing on the salt deduction?
Yeah, salt on the roads in the Northeast. There's too much salt in our diet, and it became a real sticking point in the tax reforms that were passed during the first Trump administration. Again, for people that aren't all that familiar with it, it's the deduction you can take on state and local taxes when you're filing your federal income tax returns. And the last Tax Reform Act that was passed capped those deductions at $10,000. Now, for most Americans, that's fine. But for Americans with expensive properties in some of the most expensive and highly taxed states, places like New York and California, and where you are in Connecticut, that $10,000 became a very low bar, a very low hurdle to clear. Now that deduction limit is set to expire in 2 years, but the president elect has already been talking about getting rid of it first thing. And that would open up some transactional activity, again, in those high cost, high tax states where that salt deduction really was a huge benefit to homeowners.
Hey, Rick, he's come out and he's very much anti-legislation, wants to shrink the size of government, is generally business friendly. Mm-hmm. What do you think he can do to get developers and builders to produce more supply, since we have been in such a supply constrained environment? What can he realistically accomplish there?
Well, Mark, you raise a great point. We've been underbuilding in terms of housing really since 2009, coming out of the Great Recession. In fact, it wasn't until 2023, last year, that we saw builders build at the 20-year average of home construction. So we had more than a decade of underbuilding, which has led to a massive shortage, particularly in light of the fact that we have this demographic wave of millennials and Gen Z adults coming of age and looking to buy properties. So it's a very critical need, and it's one of the reasons that home prices continue to go up. The federal government and the president in particular are rather limited in what they can do directly to correct this imbalance. A lot of the regulatory hurdles, the red tape, the price of building that's involved with these things is controlled by state and local governments. So there's some indirect things that the president can do and the Congress can do. They can use tax incentives for state governments, for local governments, to encourage them to loosen up regulatory constraints, to rezone areas that make it more possible to have denser housing in those markets. The president-elect has also talked about opening up federal lands. In fact, that's something that both former President Trump and Vice President Harris talked about. And that would be a big help because one of the biggest impediments that builders cite today is the lack of available land to build on. Now, a lot of the federal government land is in very remote places. It'd be very difficult to build residential communities in some of those areas. But there are pockets of federal land across the country that are suitable for building and that we might see made available for these builders. But ultimately, it's going to come down to, I think, both tax incentives and candidly just some good old-fashioned politicking to get people to change some of these barriers that have made it so difficult for builders to build.
Right. Are there any risks associated with the Trump administration? Is there, what are some of the negatives? You've outlined a number of positives. What should we be concerned about?
Well, there are two, and there are only two that come to mind immediately in terms of potential risks from the Trump administration in terms of the housing market, but they're pretty big ones and they're fundamental ones. The first risk is that a lot of the economic policies that were discussed during the campaign are viewed by many economists to be likely inflationary and possibly to increase the federal debt beyond its current record level of almost $36 trillion. And what that does is make it likely that borrowing costs would actually get higher rather than lower. If we have a higher federal debt, it means the Treasury Department has to print more bonds and sell more bonds in order to pay down that debt. I think most people don't realize our debt payments today are the second largest item in the federal government's budget. We actually spend more paying down the debt than we do on the military. And as the Treasury issues those bonds, it gets harder to sell those bonds. So they have to reduce the price, and that increases the yields. And the one criteria you can always count on in terms of mortgage rates, financing rates, is that they have a very strong correlation to the yields on 10-year U.S. Treasuries. That's actually why we've seen mortgage rates go up since the Federal Reserve started cutting the Fed funds rate, is bond yields rose, and we saw mortgage rates rise with them. So there is a concern that if some of these policies actually do cause inflation to come back, it could trigger another round of Fed increases. And if the bond yields go up because of deficit spending, we could see mortgage rates rise with them. The one asterisk I will put at the end of that long run-on sentence is that there's rhetoric in campaigns and there's actual policy that gets implemented. And the policies are almost never as extreme as the rhetoric during the campaigns. So we'll see if cooler heads prevail and we get policies that accomplish what the president-elect is setting out to accomplish without causing the kind of unintended consequences of economic duress.
I do want to talk about the thought of a real change in the way that we're raising revenue in the United States today, which is thinking about a more tariff-based model, right? And President Trump has certainly floated ideas on what segments of imports would be subject to these tariffs. Some would have more, some would have less. The theory is we're going to raise tariffs spur actual manufacturing here in the United States, but at the same time, raise revenue by these tariffs and subsequently cut some taxes here in the United States, which theoretically would spur more activity. A lot to unpack there. What are your thoughts on that, Rick?
I think a lot of people, because this campaign was so divisive and just because social media inflames everything, probably don't realize the tariffs are not exactly a new idea. In fact, when the United States was first launched back in the late 1770s, the way the federal government funded itself was exclusively on tariffs. There were no taxes on U.S. citizens. There certainly was no income tax. And as recently as the 1930s, tariffs were a big part of the federal government's revenue. The challenge is in the kind of global economy that we're in today, and with manufacturing costs and labor costs being so different across the globe, the likelihood is that a very severe tariff on a country like China, for example, from which we import, a gajillion different things every month, could actually wind up costing consumers more. It's not likely that the manufacturer is going to absorb those costs. It's not likely that the U.S. distributor is going to absorb those extra costs. They'll probably get passed along in part or in whole to consumers, which raises the cost of living, which is exactly the opposite of what the president's trying to do. That said, there is some logic to what he's talking about. We are typically not dealing with a level playing field across the globe. U.S. exports have tariffs placed on them pretty much everywhere we send them to, and in a lot of cases, and China is a great example of this again, where you have the country's government subsidizing industries, nationalizing industries. They do the tariffs on U.S. goods to protect their own manufacturing, their own economy. So I think some tariffs executed in a thoughtful, surgical manner could accomplish some of what the president-elect is looking to do. A blanket, 100% tariff on all goods from a particular country probably has a little bit of a boomerang impact that certainly wouldn't be what we're all hoping for. So again, let's go to campaign rhetoric versus actual policy implementation. This is a president-elect who co-authored a book called The Art of the Deal, and I believe that 100% threatened tariff is probably the first step in the negotiation to what ultimately becomes a different deal.
Well, speaking of campaign rhetoric, Trump has made a lot of noise about deportation and controlling immigration. What impacts do you see that playing? What impacts do you see having on the single family market as we are trying to build units, as we're trying to maintain affordability? Seems to me like that could be a potential negative outcome.
Yeah, there's a lot of discussion in the campaign about, one of the reasons for the housing shortage is we have too many migrants who are here illegally, and they're taking up all the supply. And I've never put any credence into that argument at all. I doubt that most of the migrants here illegally can afford to buy a house in the country. So that aside, the reality is that about a third of the laborers in the residential construction industry are immigrants, and the majority of them are probably here legally, either on work visas or permanent legal alien status, or immigrants who have naturalized and become citizens. But there's still a percentage, probably somewhere in the 25 to 33% range, of workers in the residential construction industry who are here illegally, and would be likely caught up in a massive deportation effort. The residential construction industry is already short on laborers, and wiping out a quarter or a third of the people that are currently doing the work would probably slow down manufacturing and construction of these properties. So again, I believe what we've been hearing since the election results came in is that this will be a staged process. And the first part of deportation plans are to track down the folks who came into the country having criminal records or were wanted criminals who came into the country. And then we kind of go down the list from there. But I hope there's some concession we can make that will, if nothing else, maybe expand the work visa program. Otherwise, we're going to have to figure out how to fill all those positions that we simply haven't seen the builders able to fill through any other means. So it could exacerbate the shortage of homes in the market that is already a problem. And again, that would ultimately lead to home prices going back up.
So, Rick, we've talked a lot today about different initiatives or maybe lack of initiatives that could be inflationary in the marketplace, especially as it pertains to single-family homes. There's certainly been some disappointment in the behavior of the bond market, let's say the last 90 days, and how that bond market is reacting with the 30-year mortgage rates. I'd like your thoughts on the behavior of the bond market today and what we can possibly expect closing out the year.
Yeah, great question, Jeff, and a great observation. I think the timing is what threw everybody off. We all were waiting breathlessly for the Federal Reserve to cut the Fed funds rate because then everything was going to go back to panacea and life was going to be good again. And no sooner did they cut the Fed funds rate than mortgage rates started to tick back up. And the way I'm looking at rates right now, I believe we're probably going to end this year with mortgage rates higher than they were at the end of 2023. Not substantially, but this week as we're talking, mortgage rates are somewhere between 7.1 and 7.2% for a 30-year fixed rate loan. At the end of 2023, they were at 6.6, 6.7%. So the bond markets, I believe, behaved the way they did for primarily two reasons. One, we had some unexpectedly strong economic data that hit. The most recent jobs report was definitely not positive. It was a very, very weak jobs number, but also factor in that we had a bunch of extreme weather events and an election happening at the same time, so that threw things off a little bit. But consumer spending was very strong. Inflation came in a little hotter than they'd anticipated. So we had a series of consecutively better than expected economic reports, including GDP that came in about a full point higher than most economists had forecast for the quarter. And I think that took the bond market back a step. And so we started to see rates go up a little bit there. Then you had the results of the election. And while a lot of us were of the opinion that if we had an election with some certainty to it, we would probably see the bond markets just settle in and ride through. But I do believe they're a little bit concerned about some of the rhetoric in terms of economic policies that came out of the Trump campaign, and the fact that for the first time in a long time, it looks like we're going to have complete uniformity in terms of Republican control of the White House, the House, and the Senate. So little in the way of an opposition party to kind of slow down some of these programs. So I think we see the bond market hold right around where it is, go up a few basis points, down a few basis points in terms of yields between now and the end of the year, probably between now and the inauguration, looking for some clues as to what policies really are going to be implemented, and then we'll either see bond rates go up or go down depending on what those policies actually look like.
I can't help but think the lack of clarity into the spending component of the federal government has just got to be rattling the bond vigilantes out there and just saying, when is it going to stop? It is a supply and demand equation, right? Like, how many bonds can we issue at X price before their demand for a higher coupon to buy those bonds is just reality.
Yeah, and we may have already hit that point. I think that's again one of the reasons we're probably seeing bond prices tick up a bit. The other thing that you didn't mention is what happens if we irritate and frustrate big countries who tend to buy a lot of our debt. And they just decide, you know what, enough of you, I'm not buying anymore. Good luck on the open market. And so that's one of the other factors that goes into this whole conversation about tariffs is, while you're hitting at the manufacturing level, are you necessary? What my grandmother used to call it would be cutting off your nose to spite your face. And are we annoying people that buy a lot of our debt or hold a lot of our debt to the point where they might turn on us? So a lot of moving parts here, and I think it's fascinating that for the last 2 or 3 campaigns, to my knowledge, I haven't heard a single major party candidate talk about reduced spending and reducing the deficit. That used to be a big part of the conversation, but I haven't heard anybody talking about it in years. So the closest we're getting is this new Department of Governmental Efficiency. And I actually am hopeful because there is so much waste in terms of government spending that if some of the estimates we've heard, which go up as high as $500 billion a year by just cutting out some of the nonsense spending, we could find ourselves getting closer to a balanced budget moving forward, which would certainly go a long way toward settling down the bonds market.
It is interesting because the reliance on, and correct or not correct, the reliance on the Fed to lower rates that translates into lower interest rates for homeowners is just not reality. And unless the bond market believes that some of these items we just talked about are going to be addressed, I don't foresee lower interest rates in the near future at all.
The reason I'm hopeful that we'll see slightly lower interest rates as we get into 2025 is the spread between the yields on the 10-year U.S. Treasury and the 30-year mortgage are still almost a full point higher than normal. In a normal market, the spread between a 10-year yield and a 30-year mortgage is between 1.5% and 2%. As of today, it's at almost 2.7%. So if we were just able to get the spread back to its normal range, which is about 1.7%, you could see a full point come off mortgage rates. We could be down around 6% if we got down to that normal spread. And I think for good or for bad, once we have a better sense of certainty in the direction that the administration is going to go, we could see some of that gap shrink. The other reason there was a big gap, keep in mind too, is that there was a fear we'd have a huge amount of loan prepayments because everybody expected mortgage rates were going to drop 2 or 3 points. That doesn't seem likely right now, and so that prepayment risk should be mitigated largely, and should allow that nominal decrease in mortgage rates again once the dust settles and we have a better idea what's going to happen.
So as we look into the future, how do you see the balance between bridge products like a fix and flip and a ground up construction loan? How do you see that playing against our term products like a DSCR loan? If rates are going to continue where they are, do you expect to see more bridge being originated, or what does your crystal ball tell you?
Crystal ball, it's more like a magic 8 ball at this point, Mark. I shake it and it says come back later for an answer. I believe we've bottomed out this year in terms of residential home sales. I really do believe that. And a big part of the reason for that is that we have not yet peaked in terms of millennial home ownership demand. We're 2 years away from a millennial peak, even though we're at the highest levels of young adults hitting home ownership age in U.S. history. And even as the millennials decline in 3 or 4 years, the Gen Z cohort is coming in at numbers that are higher than the baby boomers were. So we have this enormous amount of pent-up and future demand that I believe will provide a tailwind for the housing market. I actually am going to answer your question. Um, the the reality today is that affordability is the worst it's been in 40 years. So these folks who normally would be buying a house are looking to rent instead. That's creating enormous opportunities, millions of opportunities for single family rental owners, which has led to an uptick in DSCR loans. Meanwhile, there's been no inventory available. There's been no foreclosure activity going on. So fix and flip investors haven't had anything to buy and sell. And a lot of them got caught in the mix when they had purchased properties at a certain amount, planned to sell them at a higher amount, and then mortgage rates doubled. And suddenly they couldn't afford to sell the property anymore. I think we're at a more stable point right now. And in fact, for the last 2 quarters in a row, we've seen the number of flips increase, and that's the first time that's happened quarter over quarter in 2 years. And we've seen gross margins improve for flippers. So I think we'll see more bridge loans next year to fix and flip investors, simply because we're seeing more inventory come to market, because we are seeing a slight uptick in mortgage delinquencies, which ultimately should lead to a little bit more distressed property sales. But I also think we'll continue to see more DSCR loans. So I think both categories are likely to grow. I think short term, there are probably more opportunities for rental investors than there are for fix and flip investors. But I don't think that's a long-term prognosis. I think that's a snapshot of current market conditions.
And Rick, what submarkets do you see as being particularly vibrant right now? Affordability's a big issue for many. Do you see migration of people from one region to the other? Where are some submarkets where our customers ought to be spending their time and really focusing in on?
It's a little bit of a conundrum for a lot of your borrowers, Mark, because our surveys, when we do our quarterly RCN Capital Investor Sentiment Survey, indicate that about 90% of them don't like to invest outside of their home state. So, the reality is, if you're somebody living in California, somebody living in New York, tough for you to make a rental property pencil most of the time, simply because there aren't that many borrowers who want to, or aren't that many renters who want to spend $5,000 or $6,000 a month on rent. The population is migrating from the Californias, New Yorks, and Illinois of the world into less expensive parts of the Midwest, into the Southeast, into parts of the South. Ohio has been a surprisingly strong state in terms of home sales and investment growth. Columbus in particular has been very, very strong. We're seeing parts of Alabama that are doing pretty well. Florida had been red hot. Right now is starting to look like it might be a little bit close to saturation in terms of listings. So it might be time to kind of scale back on Florida activities. But the Carolinas, Virginia has pretty much a housing shortage right now. So if you can do anything to find capacity there, that's great. But again, it's broadly speaking that less expensive part of the Midwest, the Wisconsins, the Indianas of the world, Ohio, and then some of those southeastern states that we still seem to be having migration toward. And Jeff's probably sick of hearing this, but the three keys I keep telling investors to look at are population growth, job growth, and wage growth. You find a market with those three growth areas, and you're going to find a good real estate market, both for renters and for owners.
I do want to touch on something you mentioned there, which is Florida at almost saturation. I believe there are a couple of states today where we're seeing listings exceed the trend nationwide.
Yep.
Do you have a handle on where those are today, Rick?
Yeah, it's a great observation, Jeff. There are about 7 states across the country where inventory levels are now back to where they were in 2019. And Texas and Florida are 2 of those states. Idaho is one. Tennessee is one. The other 3 are less populous states. I forget exactly which ones they are. But it also interesting that Florida and Texas are 2 of the states where we're seeing in certain markets prices actually going down year over year. And we're attributing that right now to a slight oversupply in terms of housing. And Florida's Florida's almost like multiple states all in one. If you go to South Florida, there right now is a glut of condos available. If you're looking at single family detached properties, they're doing okay, but the condo market is suffering. If you look at the Gulf Coast states, they're having sticker shock because it's not unusual to see a Florida homeowner paying $10,000 a year for homeowners insurance, which makes their monthly payments go up significantly. So there's different things going on in different parts of the state, but between builders and people, and this is speculation, but people who maybe have to list their home because their property tax and their insurance went up way more than they could afford. We are seeing more listings in some of those states, and in those markets and markets like Austin in Texas, we're actually seeing prices down on a year-over-year basis. So real estate, it continues to be local, very local, and you have to understand what's going on in the market you're looking at.
Interesting that some of the hottest markets that we've been talking about really since COVID are now the markets that are reaching saturation for listings. Super interesting, Rick.
Well, the poster child of this conversation is Boise, Idaho, of all places. Whoever thought that we would center our real estate conversation on beautiful Boise? But here we are. And as we came out of the first wave of COVID, Boise saw home prices go up 47% in a year. And it was candidly a bunch of Californians moving into Boise and paying 20% over list price, which was half of what they sold their last property for in San Jose. And we're seeing a clawback in the Boises of the world, where now there's not that huge influx of people coming in from out of state. The local folks never had their income catch up to those price increases. And so because of that, we're seeing a saturation of listings, and as properties take longer to sell, and we're seeing those property values start to ebb downward a little bit. So we're seeing that in places in Utah or places in Arizona, a little bit in places in Nevada. So it's kind of we'll call it the COVID bounce, if you will, where we saw some markets. Austin was another one where prices got out over their skis. And we're now seeing the prices claw back a little bit.
How about our home state, Rick? We're both in California in different submarkets. What are you seeing happening there? I mean, we hear a lot about people leaving the state, but I don't know. Every time I see a home go on the market, there are multiple bidders going after it. I do not see home values coming down at all.
Funny you mentioned that, Mark. My wife and I were commenting on this in our neighborhood yesterday. Second house in the last 5 months. The first thing we saw go up was a sold sign. So the agent sold the property without ever even having to list it. And that same agent calls us every few months, just checking our pulse to see when we might be ready to pull the plug too. It depends on inventory levels, but California is actually doing a little bit better than the rest of the country in terms of year-over-year home sales. The most recent numbers that came from the California Association of Realtors showed a 5% year-over-year increase in September sales compared to September a year ago. And prices are continuing to go up, but they're moderating. So they're not going up quite as quickly as they did in prior years. But the median price of a home sold in California in September was $870,000. And it really does come down to supply and demand. We are losing more people than we're getting people in, but there's nothing to buy for the people coming in. And there's nothing at the entry level in our state. And if you look at where I live in Orange County, inventory levels at about a month and a half supply. So there's just nothing available. And for people that want to kind of move in to be close to Mickey Mouse and Donald Duck, here at the happiest place on earth, they dig deep into their wallets and figure out what they can afford. The central part of the state, Riverside, San Bernardino, up through Merced and that area, not doing quite as well. Prices are flat and in some cases declining a little bit. Similarly, in the Bay Area, where I think you are, or no, you're not in the Bay Area, but up in the Bay Area at the higher priced end of the market, we are seeing prices come down a little bit. So California is a huge state with multiple micro markets, and they're all behaving a little bit differently. But I do look at California as kind of a bellwether for real estate in the rest of the country. And I'm encouraged by the fact that we're seeing sales up on a year-over-year basis. That to me says that perhaps we can expect that to happen nationally in the next year.
Staying on the California theme and with a political overlay, we'll say, California has seen a great deal of success in allowing ADUs, that additional living space in existing homes, and the political overlay, making sure that local municipalities could not zone it out of existence, which is what we see in other states, where states are trying to solve the housing crisis, but then the local areas are saying, well, not in my backyard.
Yeah.
California seems to have found a way. Do you see us maybe getting broader adoption in other areas of the US?
So the California success story with ADUs, I think, has been overhyped a little bit. We are seeing some successes, and owners with properties that can accommodate an ADU are very happy with what's been going on, because candidly, it increases their cash flow for their properties. Jury's out whether it actually improves or decreases the value of the property, by the way, because a lot of these properties haven't been listed for sale yet. So we're not really sure what the market will bear when that time comes. It's kind of like selling a house that had a mother-in-law suite built into it. If you're moving in with your mother-in-law, that's a plus. If you're not, you're going to probably have to redo that part of the house, and you're not going to pay top dollar. So I think there's a little bit of that going on. And there are also parts of this, there are also counties in the state, or cities, Huntington Beach is notorious for this, that are suing the state and indicating that they don't believe it's the state's right to be able to enforce this. So it's not completely universal. All that said, I think if you're in another market that's densely populated and short on housing, and houses are as expensive as they are here, relatively speaking, there is a roadmap now that says if you do this, people will take up the opportunity to create these ADUs, and there's a benefit for the property owner to do so at the same time that you're alleviating a housing shortage. But there are other aspects that make it problematic to replicate in other areas. For example, you can't do it in Manhattan because there's just no room. Where would you even put an ADU? And that's a market that you could make an argument doesn't have a lot of available housing either. So there are geographic limitations as well as political limitations to what ADUs can do. I'm hopeful for next year, because the other problem California has is its regulatory environment is so restrictive that a lot of builders just gave up, or they're looking 3-4 years down the road when they start a project. But we are seeing an increase in manufactured housing. And these are not your grandfather's double wide trailers. These are actually really nice homes that, if you didn't know any better, you wouldn't know were manufactured units. They're less expensive to build than stick-built units. They don't require as much labor. They tend to be less expensive. And now you have a government agency like Freddie Mac underwriting the loans, which was never the case with manufactured units that could roll away at night. So, manufactured properties, 3D printed properties, there's a major builder who's actually working on those in a couple markets in Texas. So I think there's some other ways that will get less expensive housing to market, and ADUs are one of them. But I'm hopeful that both manufactured housing and 3D printed homes will become part of the mix as well.
Well, we're just about out of time. Rick, I want to give you the opportunity to express to the Trump administration what you would like them to focus on as it pertains to housing. We've documented the challenges that we're under today. Certainly the housing shortage is well documented. What would you do, maybe just a few bullet points, to have the Trump administration take up out of the gate?
So if I'm President Trump's housing counselor, or as housing czar. First, I would like to encourage them to keep to their path of reducing regulatory constraints when it comes to building and zoning, and also to continue to move away from prior administrations' attempts at kind of punishing investors. We don't need to increase capital gains taxes to 40, 45, 48%. We don't need rent control, which is the greatest failed experiment that keeps rearing its ugly head. It's like Freddy Krueger from Friday the 13th. We don't need restrictions on institutional investors' ability to buy and rent out properties because they only own 3% of the inventory that's out there. So keep the faith there and stay on course. The other half of this, though, is supply is really the issue. One of the well-intended policies that Vice President Harris was pushing was for a $25,000 down payment assistance for first-time buyers, which sounds like a great idea. And I'm sure if I were a first-time buyer, I would have grabbed the check immediately. But ultimately, it brings more buyers to market. We already don't have enough supply to meet demand. And that means that property values are going to go up for everybody and make it that much less affordable. So focus efforts on incenting builders to build, incenting state and local governments to allow and encourage building, and do what you can from a tax and policy standpoint to bring more supply to market wherever we can. That ultimately is what gets this housing market back to a state of equilibrium.
Great way to wrap it up, Rick. Fantastic. Mark, thanks for coming.
My pleasure.
It's a long way to come for a video.
Glad to be here. Always worth my while hearing and talking with Rick. Thank you, Rick.
Thanks as always, Rick. This was a fun one.
Happy Thanksgiving.
You as well.
See ya.